Let's not kid ourselves, let's not beat around the bush, and let's not say that things are not absolutely foobarred. The question is, when does the foobar end, and how much longer we can sustain this crazy inflation or these crazy Fed rate hikes? Now, I'm not saying that we don't have a recession, because we most certainly do have a recession. I'm not saying that the Fed should not be raising rates, because something needs to be done about inflation. What I am going to say is inflation is a very interesting thing. And where does all the actual inflation stem from? All the actual inflation stems from the gas prices. Not everything, but a huge portion of this inflation comes from the gas prices. Once we can somehow stabilize the gas prices, we can stabilize inflation. It's all going to trickle down. Now, it's not an overnight thing, and I don't even know how they're going to do that, but all of this is stemming from gas. One of the main things that can possibly happen, of course, is the war in Ukraine is going to end. But I don't see that happening for another 3 months, 6 months, maybe 12 months, or maybe more, because there's kind of a stalemate. But Ukraine keeps fighting on with American weapons. Ukraine keeps fighting on with NATO support. And Russia eventually is going to run out of weapons because they cannot produce enough weapons needed in order to sustain this war indefinitely. Now, there's a big difference between indefinitely, which means forever, and a long period of time. I'm sure they have enough weapons for a certain amount of time. How much? Who knows? But this video is not about the Ukrainian war. This video was about inflation, stocks, and the relationship between stocks, inflation, and what the Federal Reserve is doing right now and raising interest rates in order to curb inflation. I have Wall Street Journal, Barron's, Bloomberg, Seeking Alpha, and a bunch of other publications, and I pay for them so that you don't have to. This article came out, says stocks historically don't bottom out until Fed eases. If history is any guide, the sell-off might still be at the early stages. Investors have often blamed the Federal Reserve for market routes. It turns out that the Fed has often had a hand in market turnarounds too. Going back to 1950, the S&P has sold off at least 15% on 17 occasions. And on those 11 occasions, the stock market managed to bottom out only around the time the Fed shifted their loosening monetary policy. So the question is, when is the Fed going to loosen their monetary policy? Well, right now, they're raising interest rates, and they're actually doing some of the most aggressive interest rates hike, period. A lot of people don't realize that, but right now, at 1.75% rate, we actually raised the federal funds rate 7x from where it was just a few months ago. Now, in the 1970s, to curb inflation, Volcker raised the interest rates by double. Now, it was a different time and different rates, but you get what I'm trying to say. I'm just trying to make a comparison here. Getting to the point may be painful. The S&P has fallen 23% in 2022, marking its worst start to a year since 1932. The index declined 5.8% the last week, its biggest decline since the pandemic-fueled sell-off of March 2020. So some people have this belief that because this is most aggressive downfall, this might also be a very short downfall, and we might start recovering sooner than later or sooner than we thought. So normal bear markets, and you're going to get different information, lasts around 9 to 12 months. This is the number, more like 11 months. So if you think about it, our bear market started in around December. So we already have January, February, March, April, May, and June is pretty much in here. So we're about halfway in to the bear market. The Fed has just gotten started. After approving its largest interest rate since 1994 on Wednesday, the central bank has signaled that it intends to raise rates several more times this year so it can tamp down inflation. Well, we know that's going to happen this year. We know that in the next meeting, that's going to be July, August, there's no meeting, September, there's a meeting, October, no meeting, and then November is the next meeting. So we know that there's going to be a lot of rate hikes this year. It's not going anywhere. We know that this year is going to be bad. Next year is what we're looking forward to. So I did do a different video the other day where I said that of the 13 recessions, 7 recessions showed negative the year of the recession, followed by the next year of those 13 recessions, the post year of the recession year, only three of the 13 recessions were negative. Out of the 13 recessions, there was only one time out of 13 that we had a recession year that was actually negative and a post-recession year that was also negative, only one time. But 75% of bear markets, the post-bear market year is up at 75% of the time. So if we have a negative year right now during a recession, chances are we're going to have a positive year next year in 2023. When you take into account past statistics of a bear market, the chances of us having a positive next year is even more. And if you want to know the data, it was 17%, that the S&P went up 17% a post-bear market, if that helps you in any way, shape, or form. Let's move on. A total of 417 S&P 500 companies, right? That's almost all of them because there's only 500 S&P companies. So that's around 82, 83% of all the companies. Mentioned inflation on their earnings call for the first quarter, the highest number since going back 2010, according to FactSet. Guys, so all this data is taken with a grain of salt. And again, what happened in the past doesn't mean it's happening today and doesn't mean it's going to happen in the future, but it's very good to have all of this data and it's interesting. So if you have over 82% of the companies stating that inflation, that is an indicator that they are at least worried about that. So where do they get the data to worry about that? Well, they have analysts that are analyzing things in the current market, and they obviously watch the Adam Bergman Show, Adam Bergman's Moneymakers, and Adam Bergman's Real Estate Time. I have 3 channels, guys, 3 channels. Definitely subscribe to all of them, and they get all of this information, and then they pass this information over to earnings calls, and we get that information. And if you follow earnings calls of like Target and Walmart, you get a very good precursor to what's happening in the United States. So this is a quote by David Donabedian, and he's just a chief investment officer at a wealth fund. He says, "I don't think that the rate of decline in the market will continue at this pace, but the idea that we're approaching the bottom, that's really hard to come up with." I tend to agree with this. He also says he has discouraged clients from trying to buy the dip or buy shares and discounts with the expectations that the market will return around soon. I tend to agree with this statement, and that's how I'm playing this as well. I do have money on the sides, and I'm not doing anything to invest into stocks until the second quarter of this year. I want to see what's happening. And then possibly in the third and fourth quarter, depending on the micro and macro economic conditions, I might be buying more. But my strategy and your strategy might be completely different. I already bought up a lot of shares on the decline. I didn't time the bottom, but I was able to get in on the bottom-ish or the decline. So if things do go up, I'll be happy either way. You can't always time the bottom. You can never time the bottom, actually. And if you try to catch a falling knife, you're going to cut yourself. When the Fed began raising interest rates this year, it said that it was hoping to pull off a soft landing. A soft landing is economic moderate slowdown, and they're trying to avoid something called a recession, which is very interesting what's happening right now, because most of the time, you actually lower interest rates in order to offset a recession. Right now, the Fed is increasing interest rates during what many believe is currently a recession. We only will know about Q2 numbers next quarter, in Q3. But if it's as expected, currently we are in a recession. So going into a recession, the Fed is raising interest rates, and they're supposed to do something called a soft landing. And as long as there's jobs in the market, it's only going to be a moderate slowdown of the economy. But a lot of people are fearful that a lot of jobs and a lot of companies are laying people off. Coinbase 18%, Robinhood 9%, Gemini 10%, Walmart's going to lay you off, Target is going to lay you off, 10% for Elon Musk. Tons of companies are laying off employees. Some analysts say that the Fed's moves, and I quote, raise the risk of a recession starting this year or early next year, and it raises the risk, frankly, that they're not going to be able to keep raising rates that long. David Kelly, Chief Global Strategist at JP Morgan. JP Morgan! And I quote, I wouldn't be surprised if within a year we're having a meeting where the Fed is considering cutting rates. If that happens, stock market should go up no matter the conditions of the economy. I know it sounds crazy, but that's probably what's going to happen. Stocks have fallen a median of 24% in recession since World War II. That makes stocks' current declines happening in an absence of a recession look particularly deep. Currently, we're around that 20% when it comes to the S&P, and when it comes to the NASDAQ, which nobody cares about, we're in the 30% territory. Unsurprisingly, stocks typically don't do well during recessions. The S&P 500 has been falling a median of 24% during recessions back to 1946. If we don't get a recession, we're getting close to extreme territory, Deutsche Bank strategist Jim Reed wrote in a note. The silver lining for investors is that when the Fed begins to shift towards easing monetary policy, markets have historically responded positively and quickly, especially if the primary cause of their slide was related to central bank policy, according to Goldman Sachs. The question is, what the heck is going on with our stock market and what will be happening with our stock market? The fact is, we're already down 20%. We could be going down 30, 40, or 50%. We could not be going down any more after this. Nobody knows. What we do know is that the Fed is going to be very aggressive with raising rates. We know that the Fed is saying that we will be raising rates. If I'm not mistaken, the Feds are trying to get up to 3-point-something% federal rate hike. I have it in my last videos. So just be careful what you're investing. Be very, very cautious on the sidelines, whether you're investing, not investing, have in the market, not have in the market. But I will tell you something, and I will tell you something very interesting. The recovery for a market, whether it's real estate, stocks, precious metals, crypto, it doesn't matter. A recovery is vicious and fast. Now, I'm not saying to buy. That's not what I'm saying, and I'm on the sidelines myself. All I'm saying is I'm preaching do your own research. And it's very fascinating that people are not taking advantage of the information that's right in front of them. Read people, educate yourself, better understand the micro and the macros, better understand all different markets, and try to make money. The money made in a bull run is actually accumulated in a bear run. Does that make sense? If you're not buying on the way down or on the lower end, by the time there is a bull market, you're not going to be making as much returns as somebody buying on the way down. That's a fact. That's not like some genius statement. It is what it is. Question is, how long is down going to go? How much more can down go? That's a question only you guys can answer, but I just want to give you the data as I get it. Thank you.